Hi, I'm Alvin, and in this video, I'm going to share with you how my wife and I went from a $1.1 million condo to a freehold semi-detached located in District 15 in just 8 years. If you told me 8 years ago that I'll be able to own a landed property by the age of 36, we would have had a good laugh together because it just seemed like such an unachievable goal. I was a terribly average kid growing up, barely squeezing into university, so I was never going to get a job that was high paying enough for me to be able to afford that landed property. But I just put my head down, worked hard, made some right decisions, and before I knew it, I was able to achieve what I thought was otherwise unachievable. The purpose of this video isn't to boast, rather I hope to be able to share with you some of those decisions that I made that helped me get to my goals quicker. And if you're hoping to do something like that for yourself, hopefully this can help you. I've been in the real estate industry coming 10 years now and also lead a team of close to 50 agents. Together, we have transacted close to 750 units in the last 4 years. But before that, my very first job out of school and my first exposure to real estate started right here, where I had the opportunity to work for an ultra high net worth individual who owns a real estate fund that specializes in conservation shophouse investments. And my office was right there. Now, the Duxton that you're familiar with today, lined with fancy F&B establishments, chic bars, it wasn't always like that. Duxton used to have a pretty dodgy rep. But when the government decided to clean up this area, my ex-boss saw an opportunity to invest in an asset class that nobody really knew about and nobody really wanted to buy. So he parlayed his couple of $1 million investments into well over hundreds of millions today. So the first thing I learned is, how do you make informed decisions quickly? Is to have strong fundamental understanding about the market. Fundamentals that don't and cannot change overnight. And this will allow you to block out nuances and noises in the market. Now, bear in mind, these are multi-million dollar purchases coming right out of 08-09, the global financial crisis. So you can only imagine the amount of noise in the market. But my ex-boss managed to block all of that out by focusing on the fundamentals. Let me break it down for you. Number one, the US government is printing tons of money, quantitative easing, which will eventually lead to a rise in asset prices. Now, all that money has to flow somewhere, and Singapore, being known as a safe haven, is well positioned to attract all that wealth. So if you're a high net worth individual looking to park your money in Singapore, wanting to own a piece of mainland Singapore, there's only those few options available, one of which is conservation shophouses, and there's only 6,500 of them, and they can't tear them down and they don't build them anymore. And learning from that, I also focus very heavily on the fundamentals of the residential real estate in Singapore to build up my own portfolio as well as advise my clients, focusing on things that again don't change and cannot change overnight. Things like, number one, the growing wealth of the Singapore household, the strong household balance sheet sitting on close to $600 billion in cash, the Singapore household balance sheet that's sitting on a net cash position, so it's very low in terms of leverage. Also focusing back down on the fact that the Singapore market is still a safe haven that attracts a lot of international talent and high net worth individuals from all over the world that want to park their money in Singapore. And that brings me nicely to my second point. Having that strong conviction, strong fundamental understanding about the market gives us the confidence to take action and to take calculated risk. And the calculated risk in this sense equates to leverage. Without the use of leverage, my ex-boss and myself would not have been able to grow our portfolios to the size that it is today. But of course, mine is still a lot smaller than my ex-boss's. And on point number 3 is something that sticks with me till today because it's very easy to remember. Small money chase big money. And what did he mean by that? Because we are all small fry, on our own we cannot move the market. So it's best to tag along with the big boys. And the big boys means the government or the big name developers. So Duxton Hill was a great example of how you tag along with the government's initiative to move the market.
His other investment was located in Bugis, and that was tagging on to the transformation that happened there because Duo was coming up, JW was coming up, JW Marriott was coming up, the government was selling land that in the end translated to the Midtown developments, Midtown Bay and Midtown Modern by Guoco Land, so you could see all the big name developers moving into that area, so he tagged along to that as well. And I've also learned from that in my first property investment.
Having seen and learned how money is made in real estate and the sheer amount of which that just cannot be made by simply working attracted me to start thinking about real estate investments for myself. But what truly convinced me was how all this can be done without number one, being a genius, which I'm not, number two, taking a crazy amount of risk, which I'm not comfortable with, and number three, being terribly lucky. All it takes is to have a strong fundamental understanding about the market, understanding the supply and demand dynamics that drives everything, and riding the waves of transformation. Small money, chase big money. So being any good student, I adopted what I learned into my first investment purchase, which is to buy into the transformation story. And in 2016, there was no bigger transformation story than Jurong. We have our high-speed rail, if you could still remember, and the second CBD. And after researching a little deeper, I found out that the western side of Singapore was undersupplied by private condos at that point in time as a function of the number of HDBs available and being built. So with all that conviction and research, we took a leap of faith to purchase our first unit at Lake Grand, which is located near to Lakeside MRT. It was a 2+ study and we bought it at about $1.1 million. And thankfully, Lake Grand is within 1 km of Rulang Primary School, one of the best primary schools in the western part of Singapore. Now, why did I say thankfully? And that is because the full transformation of Jurong didn't happen. We all know what happened to the high-speed rail. So that's one learning point about investing utilizing transformation alone, is that it may not happen. Number one. Number two, that it may take a while. So I sold my unit in Lake Grand in 2020, and the new development in 2023, JDen, was still selling the Jurong transformation story. So back to the point about why I said thankfully when talking about Rulang Primary, is because when we sold the unit, we actually sold it to a couple that wanted to purchase Lake Grand solely because of its proximity to Rulang Primary, allowing us to yield a pretty decent profit of about $180,000 over 4 years. And here's another thing about our first purchase. We had some help from our parents. And this is something that we see a lot of first-timers struggling with. They either want to, number one, do this on their own, or number two, they are afraid of burdening their parents. But for us, we saw a great investment opportunity and we were confident to not just pay back the loan, but to make a better return than we would otherwise have sitting in safer investments like fixed deposits. We just wanted to take advantage of the knowledge and research that we have to get our property journey kick-started earlier. Having been blessed with getting this help from our parents, and now that we are parents ourselves, and as we speak to our clients who are parents as well, we genuinely find ourselves wanting to do that for our kids. And we don't necessarily find it a burden trying to build up that equity to help them with their property purchases, because we all know that buying a property is only gonna get harder. So we sold Lake Grand in 2020 for about 1.28 million and rolled that immediately into a 3-bedder at Park Esta that is near to Eunos MRT. So recently, I itchy backside, I couldn't go and find out like what our previous unit at Lake Grand would fetch in today's market. And lo and behold, 1.42 million. So that's 140k differential. So let me ask you, would you beat yourself up over that? Because when I told my wife, she was like, OMG. Now, this is where we need to understand one of the most important concepts about property planning, opportunity cost. And I'm going to use myself as an example. Number one, yes, I lost out on $140,000 of potential profits had I held on to Lake Grand till today. But had I done that, I would have missed out on the opportunity to invest in Park Esta, whose profits turned out to be 4 times that of Lake Grand. So for the second example, I could have gone down the more traditional route of purchasing a BTO or an EC, both of which would have basically guaranteed profits. Had I bought an EC in Sengkang in that time, prices went from $700,000 to $1.4 million. But the opportunity cost in this sense would have been the rental that I made from Park Esta and Lake Grand. For the two of them, I rented them out for a combined of only about 2 years, and I made a rental of $100,000. So there's always something that you are giving up in exchange of gaining something else. The key thing over here is to understand what is it that you are giving up and are you okay with it. The next concept to understand is time versus money. Profits in real estate are essentially the exchange of money for time. Let me elaborate using myself as an example. When I made my 2 purchases, I didn't really need a home at that point in time, so I bought new developments, waited for them to build, complete, and sell them in the resale market. The buyers that purchased those units for me at the premium, giving me the profits, are the ones that don't have the luxury of time to wait. And that brings me to my last point, knowing your strengths. So what were our strengths? Number 1, we had time. At the point of our 2 purchases, it was just Elizabeth and myself, and we weren't even married yet. Point number 2, because we weren't married, we didn't need a home. After we were married, I was happy to live with my in-laws. I was okay with that. Now, here's the thing. Would we have wanted our own space, privacy, so they can have friends over? Yes, obviously. But did we really need it after considering all the opportunity cost? The answer is no. It is important to distinguish between a want and a need. And as simple as it sounds, a lot of people have trouble deciding which is which. Having a clear end goal helps. Having an understanding of the opportunity cost of each decision helps as well. For us, we had the benefit of speaking to a lot of people, a lot of clients that were a couple of years ahead of us, and understanding what were some of the regrets they had based on the decisions that they made, which is why we decided to make a video like that. So on that note, if you found this video to be useful, please don't forget to like and subscribe as you help out the channel a ton. And for our third and final strength, which I feel is the most important and perhaps one of the rarer ones, is that we are both extremely aligned and very clear with our end goal. We wanted to get to that landed property, and we were willing to make the short-term compromises and delay our gratification to get there. Now, I noticed actually a lot of couples don't have this. They are not aligned with their end goals, and a lot of the times because of that, they are stuck in their current situation and can't seem to move forward. If you're facing something like that, please find somebody to speak to. If you cannot think of anybody, feel free to reach out to us. We find ourselves doing that for our clients a lot. But once that is done well, the vision is very clear, moving forward becomes a lot easier, because if you get stuck in your current position, all that is time being wasted.
Fast forward to 2024, we sold Park Esta at 2.3M and wrote that equity into a freehold semi-D here in District 15 for 5.2M.
So let me break it down into simplified math on how we managed to do it. So for our first property at Lake Grand, we bought it at about $1.1 million. Required a down payment of close to $200,000. We then sold that for $1.28 million, yielding us a profit, put it in a different color, of about $180,000. So the overall cash out because of this was $380K. Okay, now onto the second property, at Park Esta. We bought it at $1.7 million. That requires a down payment of $430,000. So this is where we had an additional equity top up of about $50,000. Okay, then now so we have sold Park Esta at $2.3 million, yielding us a profit of $600,000. Okay, and now onto the
current one, which is the landed property at $5.2 million, it requires a down payment of $1.3 million. The equity cash out we got from Park Esta came up to about 1.03 mil. So there's a difference, which was again a equity top up of 270,000. So the overall equity that we actually put in is 200,000 plus 50,000 plus 270,000, totaling 520k. Now you also must be asking, what about stamp duties, right? So the stamp duty for Lake Grand came out to about 30k. Park Esta 50k, for the lender about 250k, totaling 330k. So now this gives a total equity in of 850,000. Okay, so if you consider the down payment required, let me use one last color. If you consider the down payment and the stamp duties in, right, the total number is about 1.63 million. Out of which 850,000 came from our own equity, and the rest actually came from profits of $780,000. Right? This is our own money over here, and this was from profits, almost half, right? Close to 50%, which is why we are pretty sure we would not have been able to do it, and that this is why we are huge advocates of continually growing our assets. And we are pretty sure without which we would not have been able to do it, which is why we are huge advocates of continually growing your portfolio when you can. We are intending to tear down the entire building and rebuild it from scratch, and we'll be bringing you along on that journey. So don't forget to like and subscribe if you'd like to see how we are going to do it. I've done a detailed budgeting and costing for the entire purchase as well as the rebuilding works, including the construction loan, which a lot of people are not quite sure about. So if you'd like to find out more, drop us a text and we'll be happy to send that over to you. So if you're hoping to grow your assets through real estate, it is very important to have a strong fundamental understanding about the real estate market. And I'm going to take this chance to share with you guys what are some of those fundamental data points that give me the confidence to do what I do. So in case you don't already know, I'm sort of a nerd when it comes to real estate. I enjoy reading about real estate, not just in the Singapore context, but overseas as well. And this is where I noticed two key differentials between the overseas market and the Singapore residential real estate market. And the difference number one is this, is that the Singapore real estate market is still primarily controlled by the government. They dictate everything, right? Just with a snap of their fingers, they come cooling measures, demand is affected. They have also great control over the supply into the market. So I'm going to put this chart up onto the screen. This chart illustrates the fluctuations of real estate prices ever since the institution of the cooling measures in 2013. And as you can see, the Singapore real estate market is one of the least volatile markets in the world due to the sheer amount of government intervention that has come in. The prices have gone according to the government's plan of being steadily moving upwards. The second and perhaps the key differentiating factor over here is that the Singapore residential real estate market is unique because it's the only one in the world that have consistent subsidized housing coming into the market. And this is something that you don't see anywhere else in the world. But on the other hand, if you really go and analyze it and understand it well enough, that is how the government is injecting liquidity into the market. These subsidies are translated into the private market. These subsidies are what upholds the market stability. So having learned from and worked for ultra high net worth real estate investors, they always say focus on the fundamentals that don't change overnight. So these are the fundamentals that ensure that even if prices were to drop, that they will not drop in the long term. So this is where my ex-boss used to have a saying, time heals all mistakes in real estate. And that's very true, because if you really think about it and take a look at the data, there's very seldom people who hold their real estate for 10, 15, 20 years and still lose money. So now let's dive into some of the fundamental data points behind the Singapore residential real estate market that gives me the confidence to do what I do. I'm going to start off first with some of the demand side data points. So talking about real estate demand, I can boil them down into three big chunks. Okay, first, speculative demand, second, owner-occupier demand, and three would be investor demand. Ever since 2013, when all the cooling measures came online, it basically made speculative demand extinct. If we look over here, speculative demand used to take up close to 31% of all transactions before 2013, right? So what are speculative demand? People that buy and sell in a short period of time, basically flipping properties, right? So the more speculative demand there is, the more bubbly the market is, the more chance that it goes into a real estate bubble, which is why if you see pre-2013, price fluctuations can go up 15-20% and follow up by dropping 15-20% year on year, right? So that's not good for the market, right? Which is why the government has stepped in by eliminating speculative demand. They have reduced the fluctuations of real estate prices over time. Today, speculative demand basically is only limited to the segments of Singapore real estate market that do not have SSD, right? SSD is the one that have basically stripped out speculative demand from the market, right? Or taking up only around 2% of the whole market. So next up also is important to talk about affordability. Okay, so today the median household income is about 10,800, right? That translates into a private affordability of about 1.67 million, right? Taking some assumptions over here, 30-year loan, 10-year, 75% loan, utilizing the MS stipulated 4% 4% interest rates. Okay, next up, diving even deeper, over here we can take a look, right? The average 5-room owner, right, has a combined household income of about 14,000. You translate that into affordability, they can purchase something of up to $2.25 million. The average condo owner affordability, taking similar assumptions, can afford up to 3.46 million. I've also looked at the affordability based on incomes by decile. Here we can see the top 10 decile, right, which is about 143,000 households. They can afford, they have a purchasing power of up to $5 million. 286,000 households approximately have a purchasing power of about 3.53 million, and 429,000 households have about a purchasing power of close to $3 million. What's interesting here is that if you look at the Singapore resident household numbers of 1.425 million, only about 300,000 are currently in landed or private condominiums, taking up 22% of all resident households. 314,000, but as we see over here, 429,000 can buy up to $3 million. So what that tells me is that on the earning power side to things, Singaporeans are very, very okay. Other charts, right? All these charts are available on data.gov. All these charts are government and public information, right? So next up, we talk about the Singapore household balance sheet. Very, very strong. You look over here, the household net worth has been growing significantly, right, year on year, even after 2019. So here's the thing also I like to tell people, right? There hasn't really been widespread wealth destruction over the couple of years. Actually, as a matter of fact, ever since 08-09, there's been hardly any wealth destruction. What that does is because the government in the US have continuously printed money, all that money has flowed into assets, right? Which is why all this household net worth is always continuously going up. Of course, right, I'm not here to advise about what's going to happen, especially in the stock markets and that kind of thing, right? I focus more on the real estate side, so things that don't change overnight. So if we look at the Singapore Q1 2024 household assets, what I'm looking at is the cash and currency component. So basically, the Singapore household is sitting on $600 billion in cash. The Singapore household is essentially in a net cash position. So all the cash add together, right, is more than all the liabilities that we have. If you look over here, all these charts, I've got it from the MAS Financial Stability Review, which is a pretty easy read, right? Don't let the fancy titles scare you off. If you are truly interested and you want to have a strong understanding about the data fundamentals behind the market, I highly recommend you read that, right? You can just read
right? If you just focus on real estate, you can just read the household section. It's good enough, right? Quite an easy read. So here, this is a chart from that review. It goes to show, right? You see cash savings continue to go up and household debt actually coming off, right? This is another indication that the market is not speculative, it's not going into a bubble. And so in that MAS Financial Stability Review, they do stress test year on year. They publish their findings at the end of the year. So this is some of the things that they have said, right? You can see over here. They have done stress tests, right, to simulate a 400 basis point, which is a 4% increase in interest rates and a 10% reduction in income, and they still expect most households to be able to continue serving their debt, right? In addition, the stress test conservatively assumes a full and immediate pass-through of sharp interest rate hikes, right? So of course, this was talking about really the expected interest rate increase still last year. Right now, we are talking about the decrease, potential cut in interest rates. Now, how do I piece all these narratives together? So all this $600 billion in cash used to be sitting primarily in T-bills, savings bonds, fixed deposits. Once those come off, all this will start to come back onto the market. And Singaporeans have hobbies of either saving money or buying property. Don't make sense to save money anymore. We all know where all this money will slowly move towards. Now, moving on to the fundamentals behind the supply side. I'm going to start off first with HDB. So like I mentioned earlier, the government pumps in a lot of liquidity into the market because of subsidized housing. They pump up between 15 to 20,000 subsidized flats every year. While the number ranges between 15 to 20% that upgrade upon hitting MOP, there's still a lot of liquidity because on average, each of those HDB flats will sit on between $300,000 to $400,000 of profits conservatively. So now with all that profits, all that liquidity, that is what's going to uphold the market. In the private side, of course, some of them, the rest of them may utilize that to upgrade into HDB flats as well. And we've seen HDB resale prices continue to climb also, right? Again, we are unique in the world where the government is essentially pumping liquidity into the real estate market utilizing subsidized flats. Next up, I'm going to talk about private supply, and I genuinely believe the private market is going to go into sort of a period of undersupply. The reason is because supply is something that's very easy to predict. If you don't build a house this year, you're not going to have a house in 3 to 4 years' time. If you already foresee undersupply coming up next year, it's basically too late for you to make up for that undersupply. And if I analyze the two ways that land supply can come into the market, basically it's en bloc, buying it from previous owners and providing the market with more supply, or GLS. All this data, which I will put it onto the screen for you, points to me that in 2025, 2026, there's going to be a sort of shortage of new TOP condos to serve the kind of demand that we are seeing because of the HDB MOPs. Another thing that a lot of people don't see is the fact that ABSD has essentially sucked up a portion of supply from the market that will never come back online. What do I mean by that? Now, if you go into the sort of the more prime areas, the District 10, 11, 9, 10, 11, a lot of them are owned by rich families. They have bought multiple properties in the past. Today, they will not be selling them anymore, right? Last time before there was ABSD, they will leverage. Sometimes they sell and buy because they are not penalized for doing so. But today, if you have an assets of two or three or more condos or properties, you will not look to sell them, because if you sell, you buy back, you incur 30% ABSD, 20-30% ABSD. It just doesn't make sense to do so. What they do is they continue to buy, right? The rental they collect, as they collect more rental, then they continue to buy more and more, which is why I see the supply even in the resale market being very, very low in the next couple of years. Now, all this confluence of factors with reducing interest rates under supply does point to me that in the short-term future, I do see prices coming up. So I genuinely believe that prices, while high now, will only continue to climb. And that's not because it's speculative or it's a bubble, it's inevitable. The data says it all. Which is why it's so important to ensure that your assets continue to grow and are in line with your current earning power and eventual goals. We swap our assets and increase our portfolio in line with our increasing earning power. We also capitalize on our edge by utilizing leverage. Leverage in real estate is the safest form of leverage. So that gives us the option during retirement to sell off the assets, right size back down, cash out on all that equity, giving us options like helping our kids out with their real estate purchases or leading a retirement that we like, not having to burden our kids with that. Which is why I believe we should all start as soon as we can. Wait truly is a 4-letter bad word when it comes to real estate purchases. So I hope that by sharing with you my thought process behind how I plan my property moves, that you picked up on something that can help you optimize yours. I've been doing this not just for myself, but also for my clients for close to 10 years now. While not all of them are looking to upgrade to a landed property, we've managed to help them make the most of their portfolio based on what they have and what their goals. Perhaps I could share with you some case studies. I have Mr. and Mrs. Lee, both high-income bankers in their mid to late 30s. So when they came to me 4 years back, they were sitting on a 2-bedder condo in the RCR, valued about 1.2 to 1.3 million at that point in time. They weren't quite sure on what they want. They just wanted to expand their portfolio. No kids, so it's just the two of them. We had options on the table like sell one, buy one, sell one, buy two, decouple, and buy another property. So we landed on the third option of decoupling to buy another property because they were still happy with their existing house at that point in time. So we went ahead, purchased that investment property. We've just sold it, yielding us close to $700,000 in profit. Now today, things have changed. They would like to have a change of environment, so we are looking to liquidate their first own stay as well. So we are selling both and rolling it into 2 new properties. And so within a span of 4 to 5 years, their portfolio went from 1.2 million. The next stage of their portfolio will likely land them with a portfolio size of about 5.5 to 6 million, with likely the $3 million one for their own stay and the $2.5 million one for investment, or vice versa. As a matter of fact, 4 years back, we had 3 clients of very similar profile buying into that same, basically that same area, 2 in one condo and 1 in another condo. So the first example bought a 3-bedder, right? They made about $700,000, $600,000 to $700,000. The second example and third example bought a 4-bedder and a 4+ study, respectively. Right? The 4-bedder made $900,000. We do expect the 4+ study unit to also make close to $900,000. The key difference now is the next step, right? So this middle step was the same. They decoupled, bought an investment property because it was evaluated at that point in time that they were happy in their current place, right? Today, the first 2 want to move on. So we are liquidating their original asset as well. So selling both. So for the first example, right, we are rolling it into a own stay and also for an investment property. The second example, the one with the 4-bedder making $900,000, they've decided to consolidate their assets to move into about a $5 to $6 million landed, quite similar to ourselves. And for the third example, they are still happy with their original place of residence. So we are just simply rolling out their 4+ study into another investment property. So as you can see, there's no one size fits all kind of plan. It really depends on us being able to ask you the right questions. Right? Are you happy with currently where you're staying? What's your future plans? Analyzing what are your strengths and how we can capitalize and maximize them. Now that we have come to the end of this video, I hope that you have managed to learn a thing or two that can help you in your planning to optimize your real estate moves. If so, please don't forget to like and subscribe as you help out the channel a ton. If you're hoping to maximize your real estate portfolio and achieve your property goals, I can confidently say that you might just be one good move away from doing so. But if you still have questions on how can you actually achieve that, which are the properties to buy to help you do so, and you can resonate with the way we think, feel free to reach out to us via the contact I'm going to put somewhere in this video or the link below for a non-obligatory consultation. If not, I'll see you next time. Bye!